Hey guys, welcome back to the channel, and I just thought I'd make a quick video today titled Your Job as a Trader to help some of you out there realize that if done right, trading is a legitimate job and career and can add value to the markets. I was going to name this video something like trading versus gambling, but I thought I would keep it more about principles and just the way you can think about markets and your role in them and helping them make them better. And this is just something that over the years I've learned and believe, which I think has helped me a lot. So let's just get into it. The first one we're going to do here is your job as a trader is to provide liquidity. So for those of you a bit more new to trading, I'm going to show you an example of exactly what I mean by that. Okay, so here's just a little example I've made of a basic market depth order book of any market or asset out there. So in all markets, you've got resting bids in the order book and resting asks or offers. So that's the bid-ask spread. So right here, you could say the spread on this stock is 2 cents. And then you've got the quantity offered at each level as well. So there could be many orders at each of these levels, and that just adds up to the total quantity available. So for example, if you were coming into this market here on, say, this stock, and you were going to buy at market, if you wanted to buy 250 shares and you just hit buy at market, you would be filled at 50.03. If you needed to buy a bit more than 250 shares, you would have to chew through all the shares on offer at that level and then go into the next offer. And vice versa if you were going to sell at market. If you were going to sell 100 shares at market, you'd be filled at 50.01. If you had to sell a bit more than 200 shares, you'd take all those 120 at 50.01 and then you'd chew into the quantity at 50. So that's what we call consuming liquidity. And most exchanges, they'll charge you a small little fee that's all baked into your commission that you pay with your broker. And basically exchanges, one of the ways they make money is by charging liquidity takers. So those use market orders will pay a small fee, and then liquidity providers, if you provide limit orders, resting orders in the book, they'll pay an even smaller fee to them and keep the difference. So it's a maker-taker business model, and that's how it works. And that's how most exchanges work. If you're not paying a commission, what they'll do is if you go in to buy, you'll buy it at 50.029998, and then they'll offload it to some market maker who will give your broker a kickback to take your order. Now, what you want to do as a trader is act like a market maker and help make the spread. And you can do that in a few ways. So if you wanted to buy this stock, you could come in and put a limit order to buy in at 50.02. And then straight away you'd be the best bid in the market, and then basically just sit there and wait for someone to come in and sell at market, and then you would be the liquidity provider and you'd earn the rebate from the exchange, plus you've earned yourself a penny instead of paying at market. So there is some work and patience in that, and there is some risk if you want to really get in the market and it's running away from you. But overall, in the long run, you can earn a premium and do your job as a trader by providing liquidity and tightening spreads in markets. So that helps make markets better, when there's lots of different players all around the world. And it doesn't matter if you're in the middle of nowhere on the other side of the world with a small little laptop. It helps markets to be made up of thousands of nodes, all on different hardware, networks, different risk frameworks, and different traders. So in my opinion, as a trader, you should always try and aim to provide liquidity. And you can do that just by placing limit orders, or if you trade with a broker like who I trade with, Interactive Brokers, they actually offer what's known as adaptive algo and some other algos, and they're super easy to use. You just flick it on in your order panel. And basically what it'll do is it'll kind of stay with the market. If you want to buy, it'll post the best bid, and you can set different settings like fast, patient, or normal. So it'll stay the best bid until you're filled. So it'll move with the market. Using the adaptive algo from Interactive Brokers. I'm not sure with other brokers if they provide that. That's why I prefer trading with IB. I'm not affiliated with them, or I'm not paid to advertise for them or anything. I've just used them for almost 20 years, and I'm happy to pay a small commission with them because I can get the exchange rebate and I get a much better fill, which is much better than getting a free commission and a much worse fill with some dodgy market maker. So providing liquidity and tightening spreads, that's the first principle as your job as a trader. Your second job is to take the other side. So you could think of trading as kind of like running an insurance company or a casino. So you've got to take the other side of someone who wants a transaction. So say, for example, in a casino, someone wants to play blackjack. The casino will take the other side of that, and they'll manage their risk, with the size of bets they'll take, and keep a close eye on everything to make sure everything is going fairly. And an insurance company, if you want to insure your house against a flood or something, another company will take that risk, and over time they'll earn a premium for that, and they will have to sometimes pay out, but they'll manage that risk so that if they do have to pay you out, they won't get blown up. So as a trader, this ties in closely with providing liquidity. Is if you're sitting there with limit orders and adaptive orders, and you're narrowing the spread and you're tightening the spread, providing better prices to the market, then you're a liquidity provider. And then when people come to buy at market, you're taking the other side. So you want to capture that natural order flow. That's the second principle. Take the other side. The third principle, as your job as a trader, is to price assets. Now, that can be done in a number of ways. So that could be from relative pricing. So one asset might be mispriced relative to another. It could also be from information, data, economic forecasts. But basically, a market full of many traders, you're creating a lot of economic activity. You're taking the other side, and you're helping to price assets. So the price of interest rates, stocks, commodities. Traders help determine that the prices of everything should be, and add to the natural supply and demand in any market. So that's the third principle, is to help figure out what the price of assets should be, figure out what a fair value should be. And if it's mispriced or below or above that by a certain margin, you come in, provide some liquidity, place a trade, and help that asset move back to what you determine is a fair value price. Your fourth job as a trader is to help reduce volatility in markets. So you should never add to the volatility in markets. If something is trading at a huge extreme price that's completely out of whack with reality, you shouldn't come in and jump on it. Not only is that usually a bad trade when you're jumping in late with the crowd, usually doesn't work out. It's not good to amplify volatility in markets. So traders overall should serve the purpose of decreasing volatility in market, and you do that by, again, providing liquidity, taking the other side when there's been an extreme price move, and then you have to put up with that volatility, and you'll earn a premium, the volatility risk premium. So if you can manage the volatility and take it and price assets to where they should, then over the long term you'll earn a premium. But like an insurance company, you will have to pay out every now and then. So that's the fourth principle. Try and help reduce volatility in markets. And that brings us finally to our fifth principle, and that's you've got to manage your risk. So just imagine, global financial markets. Let's say they're all up. There was 100,000 different traders all over the world. If they were all vulnerable to blowing up from one bad trade, then the whole system's vulnerable. So to make the system stronger, financial markets stronger, you've got to be strong yourself and have good risk management. No one trade should ever be able to blow you up. It doesn't matter how strong you feel about a trade. You should never place your entire account in one trade. You should be careful with what you short, especially low-priced, smaller stocks. You should be careful with your overall leverage. Ideally, you should really never go over 200 or 300% gross exposure relative to your account size, and ideally never more than 100% in net exposure. So, for example, if you had a $100,000 account, you shouldn't be short $200,000 worth. You could have 100 long, 100 short, be market neutral, or 200 long, 100 short, and be 100% net long. But you should ideally never be more net long than your account size. You should always use stops and position sizing. Personally, I never put more than 20% of my account into one position. So that's the fifth principle, managing your risk. All these other four principles are useless unless you manage your risk, and staying in the game is the number one rule. So there's 5 principles you can use that I'm just sharing with you that have helped me over the years, helped to understand trading and my role in markets, and that you can serve a purpose as a trader, and it is a legitimate career, and it does help financial markets be more efficient and liquid and better priced the more traders we have participating in them. And it can also help explain to others, when people ask what you do. A lot of people think trading is just gambling, pushing buttons, guessing where stock's going to go tomorrow. And it can be for a lot of people exactly just like that. Especially if you're trading with a bucket shop broker that takes the other side of your trades and you're just going in with market orders and you have no real process or risk management. That is kind of just having to play around and gamble, which for some people is okay if it doesn't affect your life too much. But if you want to take trading seriously and turn it into a legitimate career, even a part-time job, you can approach it with these principles, and not only will they help you find purpose in what you're doing, they also actually just help you keep you in the game longer and give you an edge on markets. Because when you can provide liquidity and figure out how to price assets and manage your risk, then that's the way to succeed at trading. Okay, so just a quick video today as your job as a trader. I hope some of you found that useful. And I have had a few people ask me, do I have a course or anything else like that? I am actually working on one at the moment. And if you come over to our website, clickcapital.io, and just wait for the email pop-up, and you sign up to our free chart of the week email list. It's completely free just to get on. You'll be on our email list, and in the upcoming near future, when I'm ready to release the course, you'll be notified when it's ready, and I'll go deeper into a whole lot of topics and share with you everything I've learned from almost 20 years of trading. And I'll share with you specifically how I work out my positioning and what technical analysis I do, what setups I look for, and how I swing trade in the major US markets, stocks and ETFs. Okay, so I'll put the link below this video in the description to go to our website and jump onto our email list, and I'll let you know when my course is ready in the upcoming near future. All right, guys, cheers.